Welcome back to Stock Predictor. Today I'm finally pulling back the curtain and taking you inside my $117,000 dividend stock portfolio. This is my full December update. Real numbers, real positions, income, and most importantly, the strategy behind every move. Because anyone can show a portfolio when markets are green, but what really matters is how it performs through uncertainty, volatility, and changing interest rates. So let's get straight into it. No hype, no shortcuts, just the truth about building long-term dividend income in the real world. First, let me explain the mindset behind this portfolio. This is not a get-rich-quick portfolio. This is not a day trading account, and it's definitely not built around speculation. The entire goal of this portfolio is reliable, growing income that shows up whether the market is up, down, or completely sideways, income that I can reinvest today and potentially live off in the future. And that mindset shapes every decision I make, from position size to sector exposure to when I buy and when I do absolutely nothing. Right now, the total portfolio value sits just over $117,000. That number fluctuates daily, but what matters more than the market value is the cash flow. This portfolio is currently generating a little over $6,800 per year in dividend income, which comes out to roughly $565 per month. And the best part is that number is not static. Most of these companies raise their dividends over time, meaning that income has a built-in growth engine. One of the biggest mistakes new dividend investors make is chasing yield. I've learned the hard way that a high yield means nothing if the dividend isn't sustainable, so the core of this portfolio is built around high-quality companies and ETFs with strong cash flow, durable business models, and long dividend histories. Yield is important, but safety and growth come first. Let's start with the backbone of the portfolio, dividend ETFs. Because these positions provide instant diversification and stability. My largest ETF position is Schwab US Dividend Equity ETF. This ETF focuses on companies with strong balance sheets, consistent dividend payments, and solid free cash flow. SCHD alone makes up a significant portion of the portfolio, and for good reason. It has a history of reliable income, disciplined stock selection, and lower volatility compared to many individual stocks. It's not flashy, but it works. And in dividend investing, boring is beautiful. Alongside SCHD, I also hold Vanguard Dividend Appreciation ETF. This ETF is all about dividend growth rather than yield. These are companies that consistently raise their dividends year after year, even if the starting yield is lower. Over time, this creates a powerful compounding effect, and it balances out the higher yield positions in the portfolio. Now let's talk about individual dividend stocks, starting with large, blue-chip companies that form the foundation of long-term income. One of my biggest holdings is Apple. A lot of people don't think of Apple as a dividend stock, but it absolutely is. Apple generates massive free cash flow, has a fortress balance sheet, and continues to raise its dividend consistently. The yield may not be high, but the growth and safety more than make up for it. Another core holding is Microsoft. This is a textbook example of a dividend growth powerhouse. Microsoft's cloud business, software ecosystem, and recurring revenue streams give it incredible stability. The dividend payout ratio is conservative, which means plenty of room for future increases. This is the type of stock you buy, reinvest dividends, and forget about for years. In the consumer staples space, I hold Procter & Gamble. This is a company that has paid and raised dividends for decades. Regardless of recessions, market crashes, or economic cycles, people don't stop buying household essentials, and that reliability shows up in the dividend. It's not exciting, but it's dependable, and dependable income is exactly what this portfolio is built for. Healthcare is another major pillar, and Johnson & Johnson plays a key role here. This company has one of the longest dividend growth streaks in the market, diversified revenue streams, and strong pricing power. Healthcare demand doesn't disappear in downturns, which makes this an important defensive holding. Now let's move into higher yield income positions. This is where many investors get nervous, but when done correctly, higher yield can significantly boost cash flow. One of my key holdings here is Realty Income, often called the monthly dividend company. Realty Income pays dividends every single month, backed by long-term leases with high-quality tenants. This stock alone provides a steady stream of cash that I can reinvest or use elsewhere, and the monthly payments help smooth out income volatility. Another REIT in the portfolio is VC Properties. This company owns high-profile entertainment and casino real estate, with long leases and built-in rent escalators. The cash flow is strong, and the dividend is well covered. REITs do come with interest rate sensitivity, but that's why position sizing and diversification matter. Utilities also play a role, because they provide predictable income. NextEra Energy is one of my preferred holdings here. It combines traditional utility stability with renewable energy growth. The dividend growth rate has been strong, and it adds another layer of balance to the portfolio. Now, let's talk about what changed in December, because this update isn't just about showing numbers, it's about decisions. During December, I added capital primarily to positions that were either undervalued or already proving their reliability. I didn't chase new speculative ideas. Instead, I focused on strengthening the core, adding to SCHD, Realty Income, and select blue chips during pullbacks. I also reinvested every single dividend payment. This is a critical part of the strategy. Dividends are not spent. They are reinvested to buy more income-producing assets. This creates a snowball effect. More shares lead to more dividends, which lead to even more shares. Over time, this compounding becomes extremely powerful. One thing I did not do is panic sell, even when certain positions were temporarily down. Dividend investing rewards patience. As long as the business fundamentals and dividend safety remain intact, price volatility is noise. Income is what matters, and this portfolio continues to deliver income regardless of market headlines. Risk management is another important piece. No single stock dominates the portfolio. Sectors are diversified across technology, healthcare, consumer staples, real estate, utilities, and financials. This reduces the risk of a single event or sector downturn hurting overall income. Diversification doesn't eliminate risk, but it makes it manageable. Looking ahead to the next year, my plan is simple but disciplined. Continue adding capital consistently, prioritize dividend safety and growth, reinvest all dividends, and avoid emotional decisions based on short-term market moves. I'm not trying to predict where the market will be next month. I'm building income that can last for decades. If you're watching this and your portfolio is much smaller, don't be discouraged. This portfolio wasn't built overnight. It was built one contribution at a time, one dividend payment at a time. Consistency matters far more than timing. Starting early and staying disciplined is the real advantage. And if you're just getting started with dividend investing, focus on quality, understand what you own, and remember that dividends are a marathon, not a sprint. Short-term price movements don't define success, sustainable income does. That's the full look inside my $117,000 dividend stock portfolio for December. Real holdings, real income, real strategy. If you found value in this breakdown, make sure to support the channel, subscribe to Stock Predictor, and stay tuned, because next month, we'll do it all again, tracking the income, the growth, and the long-term journey toward financial freedom.